My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people to make friends, I'm just trying to make you a little money. My job is not just to entertain, but to put incredible days like today into context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. In a market that has been so horrendous of late, how the heck could we rally like crazy based on nothing? I mean, this was one of the best days of the year. Dow surging 765 points. S&P soaring 2.59%. NASDAQ cold-rolling 2.27%. And after last week's hideous sell-off, very few saw this one coming. Of course, every rally since last November has been a mug's game. So I can't blame anyone for wanting to dump, sell all of their stocks in this colossal advance. No rally ever seems to have follow-through these days, although we have said repeatedly, if we can just get through September, we will live to play again. That's why we need to ask ourselves if this move could be different, or will it be another temporary move that goes nowhere. We wrote extensively about this with the club today, and we've said that you've got to do a little selling. But first, let's acknowledge some things. We're incredibly oversold, meaning traders got way too negative on stocks as an asset class. You know I like to look at the S&P's proprietary oscillator to measure this. Coming into today, it was at -10. That historically means that a rebound is inevitable because there's just been too much selling. By the way, we finished the session at -9.25%. That's this day's number. That's still very positive because anything greater than -5 typically means buying opportunity. Last week, we also had historic levels of bearishness, according to a host of different services I get. And when you have this many bears, sentiment was terrible. Second, the most important single indicator we have for the direction of the market, the two-year Treasury, soared today, sending its yield dramatically lower. Now, when the two-year hit 4.35 last week in Florida with 4.4, most of the experts figured the next stop was going to be 5%, at which point Treasuries would be a much better bet than most stocks. Today, though, the two-year headed back to 4.11. Really quite a surprise, and the mood brightened considerably. Given that this piece of paper is generally viewed as a proxy for what the Federal Reserve is going to do, we heard a lot of chatter about how the Fed might be less aggressive with its rate hikes. Maybe some weaker data ahead. Incredibly bullish. That is, if it's true. So that's what's different. On a day like today, though, I think it's more important to consider why these rallies tend to be one-day wonders. Sure, we had a summer rally that gave you a nice return until everything fell apart again in August. Hey, that could happen again. We certainly turned the page from miserable September, didn't we? Good news, because that is typically the worst month of the year. For the most part, this year's rallies have been short-covering affairs, where the people who've been right, the short sellers, take profits by buying back their stocks that they're short. Buy. And they do that to close out the positions, and that does tend to send the market higher. Now, you know short-covering rallies because there are no buyers once the shorts are finished, and the stocks come right back down big after almost every single one-day wonder session. I want you to remember this concept because there are so many big hedge funds that make giant bets against the market. So when the averages fall, they like to take profits. It's just that that in order to do that, they have to buy to ring the register. They're negative, but they have to buy because they have to close out the position. More importantly, there are so many negatives in the environment. It's to the point where the most impressive thing about today's rally is that it happened at all. My feeling is that today's bounce is all about sentiment getting too negative because nothing's really changed on a fundamental level. Yes, it is true. We finally got a weak PMI manufacturing reading this morning. That was quite a surprise. But we've had so many strong numbers, meaning numbers that fly in the face of the Fed's attempts to cool down an overheated economy, that this one cold report is not enough to cause the Fed to pivot toward a less hawkish side. So why don't we do this? Let's consider what failed previous rallies and see if anything's changed so we're ready. Well, the first thing that happened is that we have been having a tough time ever since Russia invaded Ukraine, right? It turned Europe upside down. Western Europe, especially Germany, went all in on Russian natural gas as part of a misguided effort to defend the environment. Although shutting down nuclear plants in favor of fossil fuels sure seems like the last thing an environmentalist would want, they didn't realize or ignored that the Russian government's become increasingly hostile to the West. Now, Europe's economy is totally hostage to Russia, even as their sensitivities lie with the democratically elected government of Ukraine. While Russia's losing the war in the field, it's threatened to unleash nuclear weapons while also conscripting hundreds of thousands of soldiers. The winter beckons, and with it comes the cold weather that could do a real number on fuel-starved Western Europe. That's a giant part of the global economy and could be in real trouble. Not a great background for a real turn. China's the second big issue. Today, almost every tech stock rallied enormously, taking their cue from the strength in treasuries. But so much of tech is dependent on China, much more than you realize, meaning they're hostage to the Chinese government's endless lockdowns. Lockdowns they've embraced because they refuse to use good COVID vaccines. There's no sign of any change to this policy, even as the convention that will give President Xi another term is just a fortnight away. When I go through quarter after quarter after quarter of all these tech forecasts, I keep seeing that China's weighing on earnings like an anvil. That goes for many of the stocks that rallied today. Hard to see how they can keep running. What happens next? Well, look at what's happened after every other one-day rally. Analysts come in tomorrow morning, and they cut estimates, they slash price targets, and they downgrade stocks galore, especially tech. Can't think of a reason this time would be different, not after we just had that horrible Micron number last week. Then there's the biggest real issue, our economy. We have what I've been calling a WFH problem here, and that's not work from home. We have a problem with wages, with food, and housing inflation. Not one of them has changed from, say, last week. Perhaps we'll get a weaker employment number on Friday, one that shows no meaningful wage growth. That would certainly justify the rally. Or maybe the unemployment rate went from 3.7 to 4%. That would allow the Fed to back off, too. But I think we'll have hourly wage earnings and no real change in unemployment. We're going to have wage growth, no change in employment. Well, that's going to make a mockery of today's rally. Food? It's only gotten worse. There's a huge fertilizer shortage developing because so much comes from Russia, Ukraine, and Belarus. Now we have a wave of bird flu that's forcing to kill millions of chickens. Transport costs remain too high. Finally, housing hasn't resolved itself either. As is the case so often with these aggregate numbers, housing has fallen year over year, and it looks very encouraging. But it's still up usually from before the pandemic. We have tons of bidding wars for homes all over the country, and while most of the commodities that go into our houses have indeed come down, the home builders talk endlessly about how difficult it is to find help, and I'll have to pay up to do so. That's not what the Fed wants to hear. The good news for the stock market? We're getting reports that home builders are trying to offload as many homes as possible at discount prices, given the newly high mortgage rates. I think housing inflation will soon be beaten. But the bad news, real estate's inherently local, and there are many areas where we simply don't have enough homes, even with 7% mortgage rates. Oh, and by the way, let's not forget that the one commodity that had been cooperating, oil, soared today ahead of this week's OPEC Plus meeting. If crude climbs for more than one day, we're going to hear that drumbeat, and it will crush the rally that you saw today. The bottom line, Ukraine, China, WFH, inflation have only gotten worse. Now oil's going the wrong way, too. Doesn't mean there's no hope. Does mean that we're merely experiencing a textbook oversold rally. And as we told club members of the CNBC Investing Club that I want you to join, as we get less and less oversold, we will delightedly raise cash and get ready for the next downturn. Let's go to Dan in California. Dan.
Hello, Jim. Greetings. Hey, very much appreciate your great show and advice.
You're terrific. Thank you, buddy. What's up?
Hey there. IBM. Hey, I'm a true blue believer in the company with its great dividend. However, the strength of the dollar and world events makes me wonder about future overseas earnings. At this time, should I buy, hold, or sell?
You know what? You're a wise man, Dan, because it's exactly what I'm worried about. And it's why I am not going to stake my reputation right now, right here, on the earnings forecast, given the fact that so much of the business is overseas. Why don't we wait? Why don't we wait? The stock has been hammered. It could go lower. Eduardo in Maryland. Eduardo.
Hola, Jim. How you doing, man?
I'm doing fine. How about you, Eduardo?
Good, man. I've been watching you since 2005, and I'm also a club member.
Woo.
Hey, I have a
portfolio. Thank you. I want people to join the club. We got some good stuff coming. What's going on?
Hey, man, I have a portfolio position, a fast food company. I purchased it as a recession play, given how well they did during the last recession. So now with the dollar strengthening and potentially impacting overseas earnings, should I hold, sell, or buy more McDonald's?
I happen to like McDonald's stock very much. It did trade in the 220s And if it gets back there, then I would indeed pull the trigger.
Buy.
I think you've nailed it. There is some dollar worries, but otherwise, I think it's terrific. Hey, let's go local. Let's go to Greg in New Jersey. Greg.
Jim, this is Greg from Lawrenceville, New Jersey. My stock is Coca-Cola, KO, buy, sell, or hold.
Okay. There are people worried about the strong dollar in Coca-Cola. I think that is misplaced. I think it's totally factored in. Coca-Cola yields 3. James Quincy's doing an amazing job. I think the stock is a buy. All right, we're experiencing what I regard as a textbook oversold rally. I'm not sure it will have legs. On Mad Money tonight, October is Breast Cancer Awareness Month, so I'm checking in with one player focused on making women's health a top priority. Do not miss my exclusive with Whole Logic. Then there's a new oil play on the street, so is Permian Resources the best way to play the exploration production space? I'll give you my take. And right here, Mad Money celebrating Hispanic Heritage Month by talking to Agua Media. Learn more about how the company's crafting content for the Latino population. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.